Hey, Dividend investors, bonjour! This is Mike Hiru, founder of Dividend Stocks and passionate investor. Today I am suiting up because it's a big week. We're talking about Canadian banks. They will all be reporting their earnings this week, starting this morning with Scotia Bank and National Bank, I think, towards the end of the day. This video is a part one of two video series, short series about that. So today we're talking about what to expect in terms of earnings and revenues, where you should look at when you look at their quarterly statement, and I'm going to give you a quick tour of all banks, knowing what's the story behind all of them. And on Friday, make sure that you subscribe to the YouTube channel to get a notification. So on Friday, I'm going to give you a review of the 6 biggest bank earnings, telling you which one worked out, which one didn't, and which one made cut their dividend. So for today, let's talk about what to expect in earnings this quarter. So obviously, keep in mind that while in the present tense, we're going through the pandemic, and it's been a few months now that we're getting more information. The bank will tell you what happened a few months ago. So basically, don't expect much change in terms of revenue. Probably the revenue will be slightly better than last year, maybe like 2-3%. This is what we saw with Scotia Bank this morning. So not much difference here. What you're going to see though is a beat up earnings. This morning, Scotia Bank declared, I think it was like down 42%, if I remember correctly. So at least 40%. So basically what's happening is banks are increasing their provision for losses. Now, this is an accounting thing. So basically what it means is the bank, they lend a lot of money to a lot of people. So what they do each quarter is they look at their book and they're just like, this guy, that guy, this girl, they are not going to likely pay me later down the road. They were a little bit more borderline in terms of loans. So what I'm going to do is I'm going to expect part of those to not pay me, and I'm going to put some money aside. So this is what we call provision for loss. So basically, they didn't lose the money yet. It's not a charge-off. There's a big difference between that, but it does affect earnings. So what it does is, let's say you made $1 billion in profit, but you have to increase by 500 million your loan for your provision for losses. Well, then 1 billion minus 500 million, and then you have a net earnings of 500 millions. In reality, this doesn't affect your ability to pay your dividend. It doesn't affect your cash flow, but you need to be well capitalized. So obviously it will have an impact on your cash flow on that part, but it's not money getting away. It's money that needs to be frozen, and the bank needs to show those assets. Don't worry about Canadian banks. They are well capitalized. This quarter will not be the house of horror. Actually, it might be this one this summer or later down this fall, depending on how the pandemic goes. But right now, we're at the stage where you're going to see provision for losses increase. Charge-off, not too much. A lot of people, even like retailers, they ask their landlords, their REITs, to defer their payment, but they're not going to quit just yet. Many restaurants right now are closed or in old mode, so they're not ready to go bankrupt. They will eventually if those things don't reopen and then you don't go there to have a beer or a burger. But right now they're not about to go bankrupt. So they're more like moved into the provision for loss part. Instead of saying, oh, it's a write-off, then we have to take the loss and move on. So this is where we're at right now. What you should look into those statements are the comments from the CEOs telling you what they have done so far, how their loan portfolio, like put a lot of focus on the loan portfolio, knowing the charge-off, provision for loss, those are interesting things. They will tell us what's going to happen in Canada for the rest of the year as well. It's a good indicator. It's going to set the tone for the market for a couple of weeks as well, because it will be the most best overview of the economy that we can have. Now, if you're not familiar with Canadian banks, let me share some thoughts with you. First, We're good in Canada. We're good at three things. We're the nicest people, we're the best at hockey, and we have the best bank in the world. This is like the three things that you cannot take away from us. All right. So starting today, we have Scotia Bank, which is also called the International Bank. So basically, Scotia Bank has a strong footprint in Canada, but also has strong footprint in Latin America. They're the second or third biggest bank in Chile. They have branches in Mexico and all small countries in Central America as well. So their target here, their story behind that bank is they're saying, you know what? We use our strong footprint in Canada to generate some cash flow and some assets, and we have a good business model over here. And our growth part will come from not third world countries, but Latin America. Like some of them are more developed than others. Let's call them emerging markets if you want. So they're saying, you know what, those countries, their GDP will be a lot higher than Canada, so we should outperform other banks. So this is the story they've been telling us for several years now, decades. Unfortunately, over the past 10 years, it didn't work so well for them. Not that they're doing bad, but they're just not outperforming other banks, even though they have this international segment. Now, we also have National Bank that should report at the end of the day today. So National Bank is not part of the big five. It's the sixth largest bank in Canada, mostly based in Quebec. So it's like a ninja. It is strong, agile, and swift. So they have diversified their business model across partnership with Power Corporation. They do a lot of wealth management. I actually used to work there at Private Banking 1859. Pride, former employee, not going to go back there because I just love my business now, but I'm still with National Bank, so kudos to you guys. They also have lots of money coming from wealth management and capital markets, so they're well diversified in terms of bank, but highly concentrated in Quebec. So basically right now we're really looking forward to know what's going to happen with the pandemic. We all know that the province of Quebec was the worst province for the virus so far, so God knows what's going to happen with this one, but I'm still holding my shares because I just love those guys. Tomorrow, on Wednesday, we have Bank of Montreal, also known as BMO. This one is an aggressive bank that is always a little bit on the sideways because they're looking for different paths. They were the first one to go after private wealth with the acquisition of Aris Bank in Chicago a while ago. So they established themselves in private wealth. That was very smart for them. They were the first one to introduce their own lines of ETFs as well in Canada. So, you know, they're always a little bit in advance, but they're a smaller bank compared to the other big four. So sometimes it's a little bit harder for them to grow, but I love the fact that they go after the market, capital market with the ETF and wealth management as well. Then also on Wednesday, we do have Royal Bank. Royal Bank is, as the name it says, it's the king of Canadian banks. It's a huge bank first. Largest in terms of capital market capitalization, most of the time either first or second behind TD in terms of assets under management, and they are also well diversified. So they attack insurance, capital market, wealth market. They do pretty much everything, and they have obviously a strong base in Canada for savings and loans. So this is probably my favorite bank right now. Second favorite would be National Bank. Then on Thursday, we do have CIBC and TD. So those are two banks that are quite similar because they're a little bit more classic banks. So their focus is on savings and loans, doing a lot of mortgages, commercial lending, all those stuff. You know, they don't go too crazy about the rest. However, TD did a better job than CIBC, and they're just better at them at everything. Plus, they have about 33% of their revenue coming from the US. So nice US exposure with TD, well diversified. If I have to choose between the two of those, I will definitely pick TD over CIBC at any time. I understand though, CIBC, it's the most generous bank in terms of dividend yield. That is cool. But you know, if you don't have any growth vector, you may not want to stick around with a classic savings and loan bank, especially now that we know that we are in a recession and then that we're going to see lots of defaults and bankruptcies on loans. Not too sure it's the best part, right? And on Friday, the last two, and they're very the least this time. It's Canadian Western Bank and Laurentian Bank. I don't like them very much. I didn't like them last year and didn't like them in 2008, so it's been a while. I'm telling my members they should not hold those two when you have fantastic banks like the Big Five. Canadian Western Bank, their problem, well, they're mostly based in Western Canada, even more in Alberta, so you can expect that the economy is not going to do very well over there for a while. So this is why I don't really like this one. The problem with Laurentian Bank, it's the smallest Quebec bank. They have to compete against National Bank, Mouvement Desjardins, and all the Big Five. They don't have any niche that they dominate. They're not known for anything. They actually pretty much change their business model every 5-7 years, trying to figure out a way to navigate in that sea of sharks where they're pretty much the size of a Nemo. So I'm not too sure how they're going to survive that. This one is probably going to cut its dividend later down the road. I don't expect a dividend cut this time, but if things keeps going slow on the economy, that could be something that could happen later down the year, later down the road, probably this fall. Overall, I don't expect any dividend increase. This would not be wise management anyway. I rather have banks keeping their money inside, keep their capitalization, just look at what's going on and see where this pandemic is driving the economy. So this Friday, I'm going to do a wrap-up of the major five plus National Bank. I'm going to ignore Canadian Western Bank and Laurentian Bank unless maybe I have a little bit of time, but honestly, you should not look at those. If you're looking at the bank, look at the Big Five, maybe National Bank. Those are solid as a rock, well capitalized, and most importantly, they don't go overboard making stupid decisions, not because they're smart, but because laws are preventing that in Canada. So this is why they were able to avoid the 2008 crisis, and this is why right now they are stronger than ever to go through this pandemic. So I hope that you have liked this video. Nice way for an ending, right? Subscribe to my YouTube channel on Friday, doing a huge wrap up on everything that happened on this week. And until next time, stay invested.